Every empire swears its currency is secure. Every government insists its promises will last forever. And every single time, without exception, history proves them wrong. From Rome to France, from the Confederacy to modern Lebanon, people woke up one morning to discover that their savings were worthless, their wages meaningless, and the systems they thought had secure futures had stolen from them. Now comes the hard question. Is collapse rare? No. Collapse is the rule. Perhaps right now you're making the same mistakes. You're looking at bank balances, looking at national currencies, and thinking, these are solid as rock. But millions of people throughout history made that exact mistake, and they were all destroyed. The real question is, when systems fail, and fail, they do, how do you protect yourself in that collapse? The illusion of permanence is the most dangerous financial mistake, and trust can vanish overnight. Money is security. Money is not rock. History is both brutal and instructive. Every collapse leaves behind lessons, patterns, and warnings about what truly preserves wealth. And if you pay attention, you'll notice that it wasn't the most confident who survived these disasters. It was the most skeptical. Consider the Byzantine Empire, the half of Rome that survived in the East 1,000 years after the Western Empire fell. It was a work of art, an empire in decline, slowly weakening, but never quite dying. But what lay at the heart of its economy? The solidus, a gold coin. This currency was so reliable that merchants from Europe, the Middle East, and Asia would accept it without question. For centuries, it was the closest thing the medieval world had to a global reserve currency. Now I want to pose a question. Having witnessed the disasters that befell Rome's silver denarius, why did the Byzantines repeat the same mistake? The answer is power and despotism. Emperors, often with good intentions, began debasing the purity of the currency. They began to shave it down. They mixed in cheap alloys. At first, no one noticed. But then, and this always happens, trust cracked overnight. The currency that had anchored Mediterranean trade became merely political fiction. Its weakening destroyed its reliability, and the Byzantine economy lost the stability it once possessed. But here's where it gets interesting. Who survived? Those who held paper promises? No. Those who trusted in government decrees? Never. The quiet merchants who accumulated real gold or land outside the reach of the empire survived. While others watched their money evaporate, these merchants preserved their wealth. This is the first, but not the last lesson. Governments face the temptation to dilute their currency, and when they do, real value flees to assets they cannot copy. So what do you have in your investment portfolio today? Paper or something real? But collapse doesn't always come from rulers playing with money. Sometimes the shock hits from somewhere you never expected. In the middle of the 14th century, prepare for one of history's most devastating pandemics, the Black Death. Between the years 1347 and 1351, in just 4 years, roughly half of all Europeans died. Yes, half. Cities emptied. Villages vanished. Trade routes broke. Civilization, quite literally, was wounded. But here comes the surprise. The economic story wasn't simply one of disaster, because when half the labor force disappeared, labor became valuable, very valuable. The survivors could demand higher wages. Food and land, once scarce compared to people, became relatively abundant. Families with cash money, silver, goods, or simply the ability to work realized gains they had only dreamed of. Land, once expensive enough to require a lifetime's earnings, became purchasable at a fraction of the price. Houses stood abandoned. Fields and farms went untended. The survivors, suddenly, had a buyer's market. Does this sound familiar? If you lived through the COVID pandemic, you saw a modern version of this. Supply chains broke. Governments printed trillions to save the machine from freezing, and those with liquidity, those with ready cash and assets, bought real estate, stocks, and businesses at high sales prices. Those living paycheck to paycheck fell behind, as rents rose and food inflation climbed. In the United States, housing prices soared. The stock market recovered almost immediately. Millions of ordinary people struggled to pay rent. The rhyme is clear. Pandemics redistribute wealth. They always have. and they will continue to do so whenever the opportunity arises. The Black Death turned scarcity into leverage for survivors to climb the social ladder. COVID turned cash in hand, property, stocks, and companies into possessions for those with liquid assets. The lesson may not be pleasant, but it is true. Crises reward those with reserves. They punish those without them, severely. Right now, do you have cash on hand? If crisis came tomorrow, are you ready to buy assets? Pandemics show us how quickly a shock can reverse an economy. But the collapse of Renaissance Florence's banking system teaches us something else, something far more frightening. Institutions that seem too big to fail can fall like dominoes. In the 1340s of the 14th century, Florence was the financial capital of Europe. There was nowhere else like it in the world. It had powerful banking families, the Bardi, the Peruzzi. These houses had lent to rulers, princes, even kings, in tremendous amounts. The worst bet? Edward III, King of England. He had borrowed from them heavily in his long wars with France, massive quantities of gold. He paid for a while. Then he said he would stop. Edward simply stopped paying. The banks collapsed. Depositors were ruined. Trade froze. Suddenly, Florence, once rich and powerful, was locked in chaos. Nobody knew what would happen. Nobody knew where their money would go. Now I want you to answer this question. If this happened to you, what would you do? The ordinary citizen who depended on the city's powerful banking dynasties learned a reality in an instant. Reputation is not security. Fame is not protection. People learned what is perhaps the oldest lie in finance, as old as finance itself. Too big to fail is a lie. Institutions exist not to guarantee your survival. They exist to generate profit. And when they fall, they take your savings with them. This lesson repeats every century, from the collapse of Florence to Lehman Brothers in 2008 to Lebanese banks in 2019. Survival belongs to those who realize that an institution is only as good as the day its promises stop working. Nothing else. Let me ask you, how much of your wealth sits in a single financial institution? And if that door closes tomorrow, what happens? The American Civil War is remembered for its battles, its politics, the abolition of slavery. But behind the gunpowder and speeches lies another war, one most Americans barely understand even today, a ruthless monetary war. Both the Union and the Confederacy discovered simultaneously. War on that scale requires printing unlimited amounts of money. In the North, the government printed banknotes backed by nothing but the promise of the United States itself. They were called greenbacks. At first, the experiment seemed bold and patriotic, even convincing. But the more greenbacks the economy absorbed, the less they could buy. Inflation rose. Confidence wavered. While men died on battlefields, families at home watched the value of their money erode. In the South, the problem was astronomically worse. A desperate Confederacy, its resources exhausted, printed massive quantities of money called graybacks. They lost all control. By the end of the war, Confederate inflation reached nearly unimaginable levels. Prices rose in the thousands of %. Wages could barely buy anything. Even soldiers' salaries became worthless before they could spend them. Families carried bags of money that couldn't buy a single loaf of bread. Money they had accumulated over a lifetime became, overnight, nothing more than a heavy piece of metal in their pocket. By 1865, the currency of the Confederacy wasn't weak. It was dead. What mattered in this collapse? Not paper promises, not government decrees, but hard assets, land, clothing, gold, any real thing. While money became a cruel joke, those who held real goods fared better. For ordinary Southerners, it was devastating. Lifetime savings disappeared into dust, but for the shrewd and those with access, it was a chance to seize property and wealth from the conflagration of war at fire sale prices. This is a lesson Americans rarely hear, but should never forget. Your own country once experienced a monetary collapse. It happened during the war, and when it did, protection didn't come from trusting the paper in your wallet. It came from holding value that inflation could not take from you. I ask you now, how much of your money is in paper form, and how much is in tangible assets? France also offers a painful case study of how revolution can destroy money faster than war. In the 1790s, Revolutionaries overthrew the monarchy and seized church lands. They issued a new paper currency, the assignat. In theory, this money should have been secure. It was backed by the value of the confiscated property. These notes were supposed to stabilize the economy. Finance would be stabilized. Everyone could breathe a sigh of relief. Instead, the government loaded them. With each new printing, the last was diluted. Prices spun wildly. Wages fell. Farmers refused to sell food for paper money. Instead, they demanded goods or silver. In Paris, bread riots began, and the revolution ate itself. Those who survived this collapse weren't the patriots who held paper money. They were those who held food, gold, or property, things the government could not print. For ordinary Parisians, the lesson came too late. Promises, however noble, are worth only what others will accept for them. When trust breaks, your savings don't just shrink, they disappear, completely and permanently. Fast forward 2 centuries, and this lesson resurfaces in Asia, but this time faster, more global, and more ruthless. 1997, Thailand. The beginning. Thailand had borrowed heavily, in dollars. Its leaders believed the currency would hold, and their currency would remain pegged to the dollar. They were wrong. Speculators attacked. Trust broke. Debts in foreign currency became impossible to repay overnight. Investors fled. Across Asia, in a chain reaction, the currencies of Thailand, Indonesia, Malaysia, and South Korea collapsed. Economies contracted. Unemployment soared. Governments begged the International Monetary Fund for bailouts. International debt restructuring began, but who paid the price? Not global risk funds. Not those who rode the panic. Ordinary citizens whose savings lost value. Families whose mortgages doubled overnight. Workers whose jobs evaporated. You've seen this. That child who had to drop out of school. Those who held dollars or overseas assets survived the devaluation of local currency better than those who trusted it. A nation dependent on foreign debt, Wall Street institutions made fire sale deals on Asian assets while the locals were forced into poverty. It looked like a local collapse. But the truth was this. It was a global transfer of wealth. The lesson echoes from Byzantium to Argentina. Borrowing in someone else's currency is a death trap. When the storm hits, the creditor doesn't drown. The debtor drowns. How much debt do you carry? And in what currency? Right now, the same themes are repeating between revolutionary France, Civil War America, and modern Asia. Paper money is collapsing. Debt chains nations and families. And survivors are never those who trusted the system most. But the most chilling part of history, collapse is not just ancient or distant. It might be as close as one step from where you live right now. Lebanon. Between 2019 and 2021, banks did something that still seems unbelievable to most people in the developed world. They locked their doors. Citizens discovered their deposits were frozen. Withdrawals were limited. Currencies collapsed. The Lebanese pound lost 90% of its value. Lifetime savings became pocket change. People stood in lines outside banks, crying and desperately waiting, pleading to access their own money. And these weren't just the wealthy, middle-class families, retirees, doctors, engineers. Everyone who trusted the system was destroyed. The lesson was painful and clear. Your money in a bank is not a treasury. It is a loan to a financial institution that, in a crisis, can decide never to pay you back. Those who survived best either diversified overseas, held real assets like gold or property, or kept cash outside the banking system. Everyone else was trapped. If these distant-sounding stories seem familiar to you, they shouldn't be. In 2008, Americans watched their homes foreclosed and retirement funds destroyed, while the banks that caused the crisis were rescued. Confidence was restored. Bonuses were still paid. In 2020, during the pandemic, trillions were printed to keep the machine alive. A lifeline was thrown, inflating asset prices for the wealthy. Ordinary wages were left stagnant. In 2023, regional banks in the United States experienced near overnight collapses as depositors lost confidence, and it reminded us of a fairy tale we wanted to tell ourselves, that safety was guaranteed until the door was closed. Now step back. Do you see the full picture? From revolutionary France, from Civil War America, from modern Asia, the same themes repeat themselves. Paper money collapses. Debt chains nations and families. Survivors are never those who trusted the system most. Survivors are those who recognized fragility before it shattered. This isn't just history. This is a system. So how do you protect yourself while everything comes apart? History shows there is not one answer, not one system, not one asset. After the Black Death, you needed ready cash to buy abandoned land. In Florence, not trust in mega-failed bankers, but diversification and separation. In the Confederacy, hard goods, food, land, gold. In France, food and property, human necessities and physical means. In Asia, avoid borrowing in someone else's currency. Prefer international assets over local debt. In Lebanon, get out before the banks close their doors. Keep cash outside. Hold overseas assets. The patterns change, but the theme is constant. Survival comes not from blind faith in paper or institutions, but from recognizing what truly holds value when illusions collapse. And here lies the paradox that should wake you up. Collapse is both tragedy and opportunity. For those unprepared, it is ruin. Millions lose the money, homes, and futures they thought they had. But for those with resilience, liquidity, or unprintable assets, in collapse, old wealth becomes obtainable at fractions of its cost. After the Black Death, peasants became landowners. Why? There was too much land and not enough people to work it. The market was theirs. After 2008, those with cash bought houses. Millions were foreclosed. Assets were available at fire sale prices. History shows us protection is not just about defense. It's not about avoidance. It's also about what to seize when others are forced under pressure. That's a harsh reality, but it's a historical one. Throughout history, survivors weren't just those who had gold or property. They were those who could create value when others couldn't. The baker, who could still provide bread. The craftsman, who could still repair tools. The farmer, who could still feed a community. The merchant, who could still move goods across borders. These didn't just survive. They became wealthy by elevating the market. In every crisis, money loses meaning. There's never a shortage of currency. Never. People still must eat, build, trade, and those who can meet those needs, while others cannot, remain far from poor for a very long time. This is why true protection is not blind faith in institutions, not hope that governments or banks will save you. It is a combination: real assets, real skills, consciousness that illusions always collapse. The ability to create value when others cannot becomes your true protection. Every crisis ends the same way. Every crisis is a transfer, from the trusting many to the prepared few, from paper promises to tangible value, from passive savers to active creators. History has shown this pattern repeatedly, never with exception. So what is the question? Does everything fall apart? Yes. All systems, governments, currencies, banks, every seemingly critical asset has fallen to the ground. The appetite never stops. History teaches us this. History doesn't repeat. But if you ignore it, it will break you the same way, from the same place. The decisions you make today will determine your life tomorrow. How much of your money is in paper form, and how much is in tangible assets? Think about it. If tomorrow banks closed their doors, what would happen? Take action. Diversify. Invest in real assets. Develop skills. Build connections. Throughout history, confidence was destroyed. Those who were prepared survived. Which are you? If this has given you a new perspective, subscribe. There are answers in history. I will show you where to look. This is a warning from history. Fais attention. Prepare yourself. Take action. See you next time.